Federal Reserve officials are not ready to cut interest rates, and the minutes from their June meeting make that clear. The Fed released the record of its June 16th and 17th meeting this week. These minutes come out roughly 3 weeks after each gathering, and they give the public a more detailed look at how policymakers are thinking, more than the brief statement released on the day of the decision. What they show is a committee that is watching, waiting, and in no hurry to move. The central debate inside the room came down to inflation. Price increases are still running above the Fed's 2% target. Officials agreed broadly that they need to see more progress before they feel comfortable lowering borrowing costs. That is the clearest signal in the document. Patience, not pivot. The Fed's main lever here is the federal funds rate. That is the benchmark rate banks use to lend to each other overnight, and it ripples out almost immediately into the rates consumers and businesses pay. Mortgages, car loans, credit cards, business financing. Keeping that rate elevated is the Fed's primary tool for cooling prices. It works by making borrowing more expensive, which slows spending, which takes pressure off prices. But the minutes also show that officials are aware this tool cuts both ways. Hold rates too high for too long, and you risk slowing the economy more than intended. Cut too soon, and inflation could come back. The committee is explicitly weighing both of those risks, and for now, they have decided the greater danger is moving too fast. 2 areas the committee is monitoring closely: the labor market and consumer spending. Job conditions have held up well. Strong employment keeps household income stable, which keeps people spending. And sustained spending can make inflation harder to bring down. It keeps demand elevated, even as the Fed tries to cool it. Some members did flag early signs that higher borrowing costs are beginning to bite, but not enough to change the overall read on the economy. Markets track the FOMC minutes carefully because even a shift in tone can move stock and bond prices. Investors are constantly adjusting their expectations for when rate cuts might arrive, and each new piece of Fed communication gets fed into that calculus. Small word changes can carry big signals. The next FOMC meeting will be another checkpoint. Between now and then, incoming data on inflation and jobs will do much of the work in shaping what officials say and what markets expect. The practical takeaway: the Fed has not closed the door on rate cuts, but it has made clear the bar is still being set. Watch the inflation data. That is what is driving the timeline. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.